This is part of the Southwest Research and Outreach Center's Advancing Ag webinar series. Today, we're going to be talking about ag business management. Kind of the theme is, what can the past tell us about today and tomorrow? Please submit your questions through the Q&A feature. We're going to have each of our experts visit about their topic and hopefully leave some time for questions. Joining me today are members of the Ag Business Management team, Megan Roberts, Rob Holcomb, and David Bow. And so profitability has varied significantly over the last 20 years. We've been in quite a roller coaster ride. There's variation in profitability between farms, individual farms, as well as the industry as a whole when we look at averages. Many farms are still facing stress. So let's take a look at this. This data that I'm going to be looking at with you today is from the members, about 110 members of the Southwest Minnesota Farm Business Management Association. They're farms scattered throughout southern Minnesota, all collaborating with the university to get a better understanding of their farm finances and do a better job with record keeping. We do a thorough year-end analysis with these folks, and what we're looking at is the results of that analysis. This is net farm income after inventory adjustments, so we're looking at accrual income. As you can see, we're started back. I've got 3 lines here. The one in the middle is average net farm income for the group. The green line is the top 20%. So I took the top 20% of that group and got an average for those folks. Same way with the bottom 20%. So from 2000 up to 2010 and 12, we had very good increasing net farm income, a very profitable time. Ethanol was expanding its usage dramatically. We had good exports. We had our costs under control. We saw some good market prices, especially here in 10, 11, and 12. That's the last time the crop prices have really exploded like they did, like they are right now. Before the webinar, we were talking about remembering back to 2012, the dryness that really exploded the prices. And like we said, it was the Eastern belt that had more troubles with that than we did here in southern Minnesota. But a big part of this blow off here is from South America. They had some trouble growing crops back in then. So China especially turned to us for exports, and that just exploded the markets. Does any of that sound pretty familiar to what we're going through right now? But as always, the cure to high prices and high profits are high profits. South America grew some good crops. The Eastern Corn Belt grew some good crops. Acreage expanded. And we brought our incomes back down here to more of a tighter revenue situation, tighter margin situation. The last couple of years here, though, we have seen some increase in profits due in a large part to government payments in response to the tariffs that were put on, and some government payments due to COVID-19. So, I mean, look at this roller coaster ride that we have had over the last few years. This green line is the average from our top producers, top profit producers. They have really structured their business to take advantage of the opportunities that are available to them. So significantly above average. This yellow line, this is the profit of the low 20%. Look at how it hangs around zero all pretty consistently, even now during this tighter margin times, significantly below zero. Good to see this last year, they have got their head up above zero, but this is why we're looking at some stress in farm country. A full 20% of our farmers are down here in this category, and they need to look at how their businesses are structured. You know, looking forward, things look pretty good. Our crops are off to a good start. Market prices, as you'll hear, are tremendous. Our costs really aren't too bad. It's more the costs for 22 and 23 that I'm concerned about. So to talk about these issues, I've asked my Ag Business Management team to visit about them. Dave Bow is going to talk about market prices. He's going to talk about where we're at, where we've been, and what can we learn. Megan Roberts is going to talk about government programs and payments. You're going to learn that government payments have been very significant in the last few years. What can we expect in the future? What do these payments look like? I'm going to visit about cost of production. Input costs, yield, government payments, all impact cost of production. how can we react? What can we do to structure our business so that we can thrive in what I'm afraid is going to be kind of a costly era here in the next few years. And then Rob Holcomb is going to tie it all together. Variation in income has impacted taxable income and taxes paid significantly. That roller coaster ride, your taxable income is up and then it's down. Everyone wants to keep their tax bill reasonable. With all this variability, what can we do? So that's kind of the structure we're going to look at. I'm going to have Dave go ahead and visit about marketing during high prices.
All right, next slide. Oh, so here you see I did this on Monday. Here's the charts of corn futures. You see the July through December 24 and how much the prices go down. We had $7 plus for a while in nearby prices, but now we're down to $6.59. And the 21 crop, we drop $1.13. And we go to 22 crop, we drop $1.75. We go to 23 crop, we drop $2.20. And we go to 24 crop, we drop $2.45. And all those items make you think, well, I'm not going to sell any crop. The price is going so much less. But we're going to talk more about that as we go forward and show you some historical numbers to compare that to. Next slide, please. Here's the bean chart, a similar chart on Monday. You see the cash price nearby contract July was trading at $15.26. We dropped $1.66 to $13.60 for new crop. Then we go to 22, we dropped down to by 303, and 23 we dropped by 423, and 24 we dropped to 450. So below the current cash prices or futures prices. So again, all these numbers, how do we think about selling when we have the high prices right now? And another thing we just talked about, or we're going to talk a little more about with Garen, is what's our cost production. Next slide, please. Here's Worthington cash prices on Monday. You see we have a positive basis in corn. Kind of unusual. We have a high positive basis here in Worthington, and a good basis for next year's new crop bid of 40 under right now. And then you look at soybeans, it comes a little bit off the slide, but we've had over $2 positive basis here in Worthington on beans. Not the same as corn right now, 33 under, and you see the new crop bid is 83% basis, which is nothing more than normal, but you see a big drop in the cash prices from current cash to new crop bids. Next slide, please. So how often do you sell your crop at the high price during the year? Keep going through this. Never. Keep going. 1 in 10 years, 1 in 20 years, 1 in 30 years. You know, oftentimes when we get these high prices, what have you done with your crop? It's all sold already. So next slide. Here's the highs and lows in Worthington, Minnesota. Here's for the last by calendar year, so 2020. You look at the high price was $12.49 for soybeans in Worthington, and the high for corn was $4.41. Look where we are today. A lot better than those prices, even though those are the highs for the year. We see a difference each year. You got pretty wide last year in 2020, but you can look at the highs and lows every year. But look at the 45-year average: $8.63 for beans and $3.40 for corn. I would argue those would be the averages for the last few years on corn and beans, those high prices, before we had this rally that took off last summer. Next slide, please. So if you did have some crop to sell at these high prices, what percent do you have to sell? Keep going through, Garen. 5%, 10%, 20%, more than 20%. I have 4 marketing groups, and most of them just have the cleaning out the bins left to sell. If we have overflow, I do have one farmer that has 50% of his crop to sell yet from 2020. So he's an anomaly for sure. So hopefully he'll sell at a higher price, but he's already missed maybe. It's gone down quite a bit since the highs we just had. Next slide, please. So marketing your crop successfully is a challenging job. Every year you have to think about how to do it. You could hire a marketing consultant, but they oftentimes have you sell way in advance and too early too. You could sell out of the field. Ed Us talks about, that Hank, the marketing plan he just sells out of the field, has no storage. You could sell when you need the money. That guy, 50% of his crop does that. He just lives on that income when he needs it. You could sell 25% during each quarter. You could sell insured bushels from March through August when normally it's high prices. Or you could set up a marketing plan. And the positive about that is you have to execute that marketing plan as well once you set it up. And where to start. Next slide, please. So first of all, you have to figure out what your break even for 2021 corn is. So I'm just going to put a blank in here. I want you to figure your own out for corn and beans. But I'm going to assume the corn price for 2021 is $4 and bean price is $10. Looking forward to this year's fall break-even prices. Maybe even above those for some of you. Maybe less. But it kind of depends on how much rent you're paying for your input costs. Next slide. Here's a basic marketing plan. Ed Ussett has done this as well. You put your kind of crop, you're comfortable with your insurance, and you're able to sell those insured bushels. You got the bushels, a cash price, futures price, and a decision date to make some sales, and using some tools. The plan starts in the bottom, and the premium. I traveled Ed last time we had these high prices, and I was doing marketing programs with him. He sold out way too soon. So since then, he's put a premium in this plan so he doesn't sell those early sales too early. And then you ignore decision dates if the price is lower than your based your cost of production right now. Okay, next slide. So again, I talk about $4 and $10 for the cost this year. When I do these marketing groups, I've been doing them since 1999. This is the first years in 14 when we did those plans and the break evens for 2021 crop. The prices were actually above. We could forward contract price above $4 and $10 at the local elevators. So that's a great thing to start. It's a great opportunity we have this year. Does it feel like it? When we got $15 cash and $5 plus or $6 plus for your corn, the $4 and $10 feel good. Those are the best opportunities we've had in a long time. Next slide, please. If you're not willing to sell right now, you think it's too early, maybe you want to have a tool behind the scenes. You know, it doesn't like options, but you know, maybe you want to market the crop, lock in these good high prices. Maybe you want to re-own options. Some people call it a courage call. You make the cash sale and then you re-own the crop with a call. Next slide. Here's the premiums yesterday or actually on the 24th. Here was the premium. So we were trading, I think, at 540, 550 in there. And there's your premium. So 58 cents on the 540 call to re-own it, or 54 cents on the 550. That's a lot of money to give up. But if it takes you that to sell crop today for probably your break evens, you still own the crop in case the market does go higher. Right now, the market's been sitting down a little bit, but this gives you that courage call. Something to think about. Or you could buy the insurance on the price and buy the puts too. Everything to think about. Next slide, please. Percent of time we're above these prices. Right now we're above $6 in the last 5 years. In the crop marketing years, September 2020, 0% of the time in the last 5 years we're $6 or higher where we are today. You see in the last 15 years we were 23%. So pretty good odds there, but again, 0% in the last 5 years where we are today. Next slide, please. This is an interesting slide. This is the last 5 crop marketing years, and you can see June is the highest price on average to sell your crop. The blue line is the average for the whole year, and you can see how much higher June was, and it actually got below in July and August, September were bad months. So we're in a good time now. We're just coming into May and into June. Think about making some sales. Next slide. Here's the historical average. It's 25-year average for the high seasonalities of prices. You can see May and June is really the best times to sell on this contract time as well. Next slide. Here's the bean market. So we're at $15 plus, but let's look at $13, which is where next year new crop bid is above 0% of the time. We've been at $13 or above in the last 5 crop marketing years. 24% last 15. So again, same kind of odds as corn, and those prices break evens. $6 will pay your bills, and so will $13 beans if we have a normal crop. Next slide, please. Beans, just like corn, June was the highest average price in the last 5 years. July was at the line, and August dropped way off. And a lot of times we've seen, you go longer years recently, August is actually above average usually, but you see in this last 5 years, it dropped way off. Next slide, please. Here's the 25-year average. Notice the high price on there. It's going to go to $9 even. We had 2 years before this last rally last summer where we were below $9. Never got to $9 cash beans. Next slide, please. Here's the March to July movement. So again, you know, we're in this time frame from March to July. What do you think it's going to do in the markets? Look at the corn market. Only increased 1 cent on average over these years. You can look at, I kind of use 2012 as a guideline compared to what we are in 2021. So what happened in 2012? It did increase quite a bit yet. Same with beans. It did increase quite a bit. But on average, only increased to 27 cents and 1 cent on corn. Next slide, please. This is from Winning the Game program. This goes, if you look at the chart here, the average price movement. So again, look at 2012. On May 1st, we're in May yet, to October 1st, the market improved over $2, $2.18 in that year, which I'm considering similar to this year. Right now, it's not looking like it's going to do that, but it took 3 months and it took off again, depending on how the crop turns out in 2021. But you see the average is a decline of 33 cents. So again, good incentive maybe to sell your crop now. But again, there are a few years where it didn't go higher or didn't go lower. Sorry. Next slide, please. This interesting chart I put together. I have a market group in Sleepy Eye, Brown County. I have their monthly charts from the markets there in Hanscom, Minnesota. And this shows you the cash price bids offered in March of 2012. So the 2011 heading says that's the 2011 crop. So you mark it in 2011 through September 2012, and 12 and 13, and 14, 13 and 14, 14 and 15. So here's the cash price on the left, then for the 2011 crop, and then I've got the averages from March 12 to October 12 is $6.74. Compared to the 2012-13 crop, it's $6.15. So you lose a little bit, but it's still a relatively good price. So, it didn't fall dramatic like you're seeing right now. If you went to the next year's 2 years out, it was $5.30. So going 2 years out, you lose $1.44, but not as dramatically as our cash price we have now. And those prices are how that works. Now, so with similar charts comparing those different years going from May 12th to September 13th. So next slide, please. You see here, I'm emphasizing the difference. So the average is only about 6.59 cents less from 11 average to the 12 crop average, which would be 21 average to 22 average by comparison. And go to 13, it drops $1.44. Next slide. You go the following year out. So again, back in March of 2000 or May of 2012 through September 2013, the cash price forward contracted was $6.70. We go to 5.20 and 4.95. So we didn't drop off near as much in the later years, but we did drop significantly from 6.70 to 5.20. Next slide, please. So here's soybeans. Same kind of chart, same kind of crop years. You see the average below. Next slide, please. Here's the emphasis on the average of those March 12th to October 12th was 14.72. We didn't drop a dollar. We dropped to 13.98 for the next year's crop and 11.93 for the following year's crop. So we did drop significantly, but all three of those prices in both corn and beans would make your farm recover your expenses and pay the bills. May of 2000. Next slide, please. And look at the following years. You go from 14.42 to 12.70, 12.17. A big drop there, over $2 in that time frame. So we lost the incentive. But again, we're on the second year, looking forward 2 years after that crop. So they kind of have a, in 2012, 2013 crop didn't go up so much, so the price stayed relatively good. And then it dropped off significantly going forward after that. Okay, next slide, please. Here's the yearly averages for cash corn in Wilmington, Minnesota. $3 since 14 every year, cash average price. $9, around $9, a little less than that since 15. You see, then we had that 12 rally prices. Those are the average cash prices in 12. Stayed high in beans on 13, and stayed high in corn on 13, but went down some. And 14, it still stayed high in beans, but dropped significantly in 14 for corn. Give you an idea what trends might be. So we still might stay strong next 2 years because we've got a short crop from last year. Depending on what the growing conditions are this year, we've got good demand from China. So all those combinations are adding to a good market. Next slide, please. We talk about input costs. I'm going to tell you the biggest input cost is rent. For some big numbers for rent again, as we're having these good grain prices. But the purple column in the middle is the biggest bar. That is land rent. On corn, that's about a 30-year cost. So we see the trend is kind of flat for the last several years going forward. Next slide, please. On soybeans, you see rent's about a 40% of the input cost on rent. So your rent is your biggest variable to figure out what your break even on those prices are. Next slide, please. Input costs. When we're talking 21, 22, 23, and 24, what's the trend been? So for the last 10 years, about a 1% increase in input costs. Even though the high was in 2010, it's dropped in 19 and 20, it went up. So we're seeing about a 1% increase for input costs. You could plot that going forward a couple of years. It might be higher than that now because we're having fertilizer costs, rent cost increases. If you look down on soybeans, they've been averaging about 3% a year. So if you wanted to plot your prices break even what they were, if they're $4 and $10 this year, I could take 1% or more for each of the next 2 years or 3 years and 3% more on beans and get an idea what my break even might be going forward. Next slide, please. This just shows you the prices the farmers got in southern Minnesota, 1,200 farmers in the Adult Farm Management Program. Look at those average prices. So you see the 12 year was a really good year. 13 was pretty good. So maybe next year will be good too. But then you go forward and the prices really dropped off on corn. It took a little while for beans, 1 more year for beans, but those kind of give you some ideas of where we could go if we have normal crops coming forward. Next slide, please. That's it for me. Turn it over to Megan.
Okay, Dave, I have one question real quickly. What changed the market so quickly? Was it all because of demand and weather, or what influences from the economy changed the commodity markets?
I would say that the combination of demand, China was living up to the Trump agreement. They started buying a lot of our commodities because it wasn't available elsewhere in the world. And the other big thing was the Iowa windstorm. I don't think the markets really took impact that. The market didn't take off till May and really August for corn and May and for soybeans. That did not show up until, and then South America had a poor crop as well. So all those things just kept fueling that fire to where now our world supply is about where it was in 2012. Our ending stocks are tight. So really it's
We are in a global economy now. Changes anywhere in the world really impact the prices.
Yep.
Good. Thanks for that question from the audience. Okay, I'm going to have Megan visit about government payments. Boy, they've been significant here these last few years.
They certainly have. I mean, to segue from Dave's presentation to what I'm going to share over the next few minutes here, you know, a year ago, we could only dream of $6 corn and $15, $16 beans. We were in a really difficult spot about a year ago, certainly on the corn and bean side of things, but let's look at it more broadly and talk about where we were last year for, say, the hog market. And we were at $30 hogs. And that was if you could sell your hogs. We were at really a roller coaster with the dairy industry. They had bottomed out at $13 a hundredweight. And then by June, we were up in $24 range. So just some really unusual things. So let's talk about farm level impacts of federal and state financial policy in the context of the last couple of years. So we can go to this next slide here. Of course, as Dave already mentioned, we had prior to COVID some really significant trade issues. So even before COVID-19, we were in this era of some very unusual ad hoc payments. So ad hoc, of course, Latin for in this situation. So this is going to be a government payment that is not planned. It's not part of our traditional crop insurance safety net. It's not part of our traditional farm bill safety net. And we had these market facilitation payments that kicked off our recent ad hoc payments trend. Then we moved into 2020, 2021. We have this pandemic. It is significant disruptor for all industries, but we certainly see these disruptions in the agriculture industry. And it was right around this time that we had our first major USDA announcement. It was Memorial Day weekend, Friday, that CFAP 1, Coronavirus Food Assistance Program 1 was announced. That was followed up in September by Coronavirus Food Assistance Program 2. We are currently right now still in a period of time where you can potentially sign up for additional assistance through Coronavirus Food Assistance Program 1 and 2, primarily crop producers, hog producers, beef producers. They've already received their payments, but some of our specialty crop producers are still working through this additional sign-up period that's happening right now. And we potentially still have a tail end to Coronavirus Food Assistance Program with a potential CFAP 3. Primarily, the talk is for those niche agricultural producers that could happen sometime this summer. And that would be under the new titled Pandemic Assistance for Producers, which is a slight change in acronym under the Biden-Harris administration. So a lot of ad hoc payments, pretty unusual. We can move on to the next slide here. As we look at what did CFAP 1 actually look like, we had about $10.5 billion worth of payments that were sent out to producers across the country. We have very significant payments in cattle and milk and corn and hogs during that first round. Here in Minnesota, we see a lot of those commodities during CFAP 1 getting significant payments. It was really difficult if you were a specialty crop producer, a specialty livestock producer, to qualify for payments here in Minnesota under CFAP 1. but nationwide, about $10.5 billion went out in CFAP 1. Moving on to CFAP 2, we see an even larger amount go out, $13.2 billion. Just really, really unusual, gigantic ad hoc payments in the context of agriculture. However, in the context of where prices were at the time, you might be able to argue in some of these commodities that it was really that needed lifeline that kept those farms going. We see a little bit of a shift in CFAP 2 with corn taking the top spot. And there are some, questions about whether or not those crop payments really were needed in those amounts at those times. But this is what the data is for how much that went out at that time, about $3.3 billion to corn producers, cattle coming in second, and then a lot more of those specialty crop producers qualified under CFAP 2. Next slide. So as we think about ad hoc payments, what is also particularly unusual about the government payments during COVID-19 is we see a lot of aid that is coming also from outside the United States Department of Ag. So generally, if a farm is going to be interacting with the government in some sort of financial relief, it's the United States Department of Ag that is the fiscal agent for that money. Not so true in COVID-19 times. We also see significant aid from other areas. So as we move into this next slide, we can see that there were significant tax credits that were available. And, tax credits and tax law is something that farmers are always kind of looking at. Rob's going to be at the tail end here and talking about the ways that farmers can tax plan. But during COVID-19, we had extra ability to access funds. We had an employee retention credit. We had paid sick leave available. More significantly was the Paycheck Protection Program offered by local lenders through the Small Business Administration. Certainly small businesses, of which farmers are a part of, can access Small Business Administration loans really throughout time. There's certain ones that we're not typically eligible for, but PPP was brand new. Farmers were eligible, and it was something that was pretty wildly popular during April of last year, so much so that it ran out of money, had to be refunded. We see a lot of farmers that participated in both the first draw of Paycheck Protection Program and then also the second draw, which was made available during the December Consolidated Appropriations Act. We also saw the economic injury disaster loans as an option. That is something that has existed within Small Business Administration for years, but farmers were not eligible for this until April of last year. Late April, farmers were made eligible for economic injury disaster loans and also the advances. So that was a Small Business Administration program as well. If a farmer did have an existing loan at Small Business Administration, they might have experienced debt forgiveness during those early months of COVID. And on top of that, we also see federal funding from the CARES Act, from December's Consolidated Appropriations Act, and then most recently here in March, the American Rescue Plan. Those federal funds going to the state of Minnesota and all the way down to counties, and farmers potentially being able to access those funds at that state and local level. For example, mentioned that the extreme challenges we were facing in the hog industry last summer, and there was pretty decent funding through our Department of Ag to help assist with some of those costs, and that was through these federal funds that have been appropriated to the state. As we move on here, let's talk about at an aggregate level how much government aid there has been, and then I'll end by bringing it down to the farm level. So if we add everything up and we look back at Market Facilitation Program payments, which those came out our last payment for market facilitation program was weeks before COVID started. So we had 2018 and 2019 through 2020 payments. We added all up 8.6 billion in 2018, 14.5 billion. And if Garen, Dave, Rob, and I were talking pre-COVID, we would say, wow, market facilitation program payments. Who would have thought we would have this much ad hoc aid coming through our federal government? Well, that was blown away in comparison to coronavirus food assistance program. In just 6 months, $23.8 billion of aid went out directly to farmers. Then we got to add in Paycheck Protection Program and other things. Estimates for ag are initial. We still don't know if everyone's going to receive full forgiveness, but there's some estimates around about $9 billion across first draw and second draw. And finally, there is still the potential of a third coronavirus food assistance program, likely targeted a little bit away from our row crop producers. We just heard Dave talk. That's probably a good thing at this point. We've got some really substantial prices, but if that third round goes out, there could be as much as another $13 billion for coronavirus food assistance program. When we draw that aggregate amount down to the farm level, what did that mean in terms of our net farm income? Our next slide here, our data, and this is for not just the association numbers from Garen's producers. This includes our entire Minnesota FinBin database, so Southwest Farm Business Management Association students, as well as the Minnesota State College and University Farm Business Management students. The government payments are about 12.9% of gross farm income in 2020. So from a gross farm standpoint, not hugely substantial. But when you start looking at the net farm income, 60.5% of net farm income. That also, I want to point out, is not just the ad hoc payments that I just discussed, but also our farm bill payments, ARC, PLC, things of that nature as well. And it's similar across all different types of farms. So whether livestock or crop, across our FinBin database, we're at about that 1/10 of gross farm income from government, and as much as 60%, 2/3 of net farm income from government sources. If we want to hone in on ad hoc payments, we have to go beyond just government payments and look at a category called other government payments. And that's going to include those things like CFAP, like Market Facilitation Program, but also things like WIP Plus. And if we look at that over the last 3 years, other government payments have doubled year over year. So 2018, we had just that little bit of MFP. 2019, we had a little bit more, and then COVID hit, and the bottom fell out, and the government stepped in and issued these really substantial payments. I think as we look at where prices are, it is likely that we will not have this substantial amount of government payment in 2021. But it's really interesting to be able to look at what has happened and try to predict where we might be going in the future. And I certainly don't have that crystal ball. And with that, I'm going to hand it over to Garen. Maybe he has a crystal ball to share with us all about where we're headed in the future.
Well, I have to agree. I can't imagine government payments being as significant as they have in the past, but I've been saying that now for quite a few years. And but, you know, we do have the ARC and the PLC program, kind of revenue-based programs. I remember after those high price years of 10, 11, and 12, that gave us some pretty good revenue protection. But going forward, it's going to take a while for those good prices to work their way into that calculation. Am I thinking right, Megan?
Yeah, you're absolutely thinking right. So if we look at our programs through the Farm Bill, ARC and PLC for corn and beans, the guarantee that's used in those calculations is an Olympic average. So it's going to look at 5 years, and then it's going to take away your high and it's going to take away your low. Because we only have 1 year of high prices right now, they're going to drop out of that calculation. Even if for the last 2 years of this cycle of the Farm Bill, we stay above $6 for corn, I crunched the numbers, we would get a whopping 3-cent increase in our price in our guarantee calculation. So moving past 22 and 2023, if prices stay high, that could increase our reference price, our effective reference price. But for the time being, because of Olympic averages, we're not really going to see any major differences in the Farm Bill protections for price. That could change in the future.
Right. So I think we really need to look more towards the market, more towards keeping our costs under control. And that kind of leads me into what I'm going to visit about real quickly here, cost of production. Cost of production really is based on three things. When you think of cost of production, first thing comes to mind, well, my costs. But yields are a very important part of that cost of production, and I'll show you why here in a little bit, as well as other income, government payments, crop insurance. When FinPac, the financial software we use to calculate these cost of productions, it subtracts government payments and crop insurance from the applicable year to arrive at a cost of production. So let's take a look at that. In 2020, the average corn producer cost $6.83 to grow an acre of corn. His operator labor and management was $59. And boy, I think we really need to include a figure to pay ourselves to do this work. Government payments and other incomes was 51 bucks. We had an average yield last year of 201 bushels. So that's a 322 cost of production. So that's kind of where we're at right now for the 2020 crop. So let's look at the components of that cost of production on a per bushel basis. The first is yield. Going back to 2000 here are our yields from the members of the association. I drew a trend line in here. Corn definitely is on the upswing. We've got a good trend line going on there. Very good crop last year. But boy, look at these years down in here. We've been below trend line many years. That makes crop insurance very important. And when we're calculating our future crop cost of production, we can't just use these good years. We need to be looking at more of a trend line. And while it doesn't seem so, beans definitely have an upswing in the trend line as well, but very similar to corn, same story. Boy, every once in a while we get down here significantly under trend line. So boy, when you're making your future plans, I think you really need to look at trend line yields rather than the very best yield you had in the past. So here's our corn cost per acre chart. Looks very similar to the one that Dave had. Mine goes back to 2000. Started out about 300 bucks an acre to grow an acre of corn. Boy, look at how these crops expanded during that good profitable level when we seen good prices and good yields, and got up to a peak here of $750 in 2013. It has leveled off somewhat now that we got into this period of tighter margins, but boy, not very much. It's kind of leveled off here at about 660, somewhere in that neighborhood. There's an adage in the commodity business that costs are quick to react to good prices and slower to react to tighter margins. Boy, this chart just shows that to a T. I mean, here is that rapid increase in cost per acre and a slow decrease as we get into tighter margins. Looking forward to 2021, I'm thinking our cost per acre isn't going to go up that terribly much. A lot of folks negotiated rents last fall. They bought their fertilizer, maybe they bought their seed before we had this huge increase in prices. So a lot of folks already got that prices locked in. My concern is the 2022 crop. Next fall, we're going to be negotiating rents. The landlords are watching the markets just as closely as you are. If there's anything that follows market prices, it's fertilizer. And if you've tried to buy some lumber to repair your building or got some parts down at the machine shop, those prices have already increased. So that's what we need to look out for moving forward. Government payments, they're an important part of figuring cost of production. And boy, 5 out of the 6 last year's government payments have been above 40% of net farm income. Huge payments, significant impact on government, on the cost of production. I just don't see that they're going to continue at the levels that they have been. So let's look at the cost of production on a per bushel basis. I've got 3 lines here. The yellow is for the average producer. The green is for the low profit 20% cornfields. and the blue is for the high profit. So very similar to our per acre chart, we've seen this rapid increase in cost per bushel to grow a bushel of corn, leveled off here during this strong period, about $4.50, and it has came down. Now, it has come down on a per bushel basis more than a per acre basis. Why is that? That's because our yields are on a trend line moving up. We couldn't survive at this kind of cost per acre if we were still looking at 150 bushel corn. But look at this low profit 20%. Boy, it cost them $3.80 to grow a bushel of corn last year. Compare that to our high profit group, $2.80, over $1 difference. You drive down the road, you look at one cornfield on the one side of the road, another on the other side. You can't imagine that there's $1 per bushel difference in what it costs them to produce that corn. But there is in many cases. And I think what we really need to do is find some way that we can get to that advantage. Maybe you have a green thumb. Maybe year in and year out, you can grow corn better than average. Maybe you're an expert at cost control. Maybe you're an expert marketer. You have to do something to get you into this category. Because there's an old adage in the commodity business that cost of production often goes to market price, or market price goes to the average cost of production. And we'll see that here in just a little bit. So this black line is the average price received per bushel for corn from 2001 to 2019. The red line is the cost of production for that corn. So anytime the black line is above the red line, you've got profit. That's what we like to see. And these are those really good profitable years we saw back in here. But look at what has happened lately. Look at how this cost of production and market price have come together. And that's what I'm talking about. In the long run, they're going to come together to the average producer. That's why you have to figure out a way to be just a little bit better at average than something. And just so we can prove the soybeans look almost exactly the same, here's that exact same chart showing profit, good profit in growing soybeans during this time period. And boy, she sure has leveled off and evened off here. I think in the next couple of years, we're probably going to see these good prices give us an opportunity to show some profit. But boy, we have to have our costs under control here for when the costs really come to hit here in the next couple years. We talk about efficiency a lot at Southwest Farm Management. We talk about 5%. Can you grow 5% better corn, 5% better marketing, 5%? So that will lead to a doubling of net farm income if you can just do those simple things. 5%. You're not going to go to a landlord and say, I'm not going to pay the second half of your rent. You're probably not going to be farming that farm for very long. But boy, if we can just get 5%, because there are always storms. 2019, we were looking at trade wars, planting, green snap, late planting. 2020 was COVID-19. What a roller coaster ride that whole issue was. 2021, are we going to continue to get government payments? Boy, it was pretty dry this spring. I know a lot of folks were a little nervous about that. And input costs. And like I say, 2022, input costs. I'm screaming input costs. Efficient farms sleep the best at night. So why do we think expenses react quickly to better profit and slow to tighter margins? I guess my opinion is it's a lot in how farmers buy their inputs. They are so used to buying ahead. They line up their cash rent the fall ahead. They line up their fertilizer, their seed. So on the way up, when profit is increasing, that's a good thing. You've got your inputs bought reasonably. But when we flip over that other side, then you're buying expensive inputs, and maybe the prices aren't as good coming forward. So maybe that's something to keep in mind. Maybe protect yourself by selling some grain when you buy those inputs to kind of put that together. So now I think I'm going to have Rob visit about taxes. Boy, with this variation in income, how does a guy keep his tax bill reasonable? You don't want to pay in the very highest tax bracket one year and then show a loss the next year. So Rob, I have given you that daunting task of helping us figure out where to go from here. And I know you are up for the challenge.
Well, thanks, Garen, and welcome everybody. Appreciate you tuning in today. My end of this is going to be pretty short because Garen describes this as a daunting task. Actually, I'm going to make it pretty simple for everybody. Go ahead and advance the slide. I have very few slides in the deck here, but in my short amount of time that I have here, we just want to talk about a few things just to keep on the radar, and then give you some strategies that I think are going to help you in the tax planning from year to year. Just an FYI, qualified business income, or QBI as we've come to know that came out of the Tax Cuts and Jobs Act that was passed in 2017. That's going to sunset for tax years beginning January 1st, 2026. So, we're 2021, basically, we're running on a short number of years. That could get extended, but, as of right now on the books, that's scheduled to go away. So, keep that in mind for moving forward. Now, also want to touch a little bit on accelerated depreciation, prepayments, deferral of income in general. And, then I want to wrap up with some tax rate thresholds that you want to kind of take into consideration. So go ahead and advance this, Garen. We'll go through this discussion. Now, unfortunately, on the depreciation side, one of the most common things that producers do to minimize that tax bill is you go out and you buy some new machinery, and you can use the section 179. Now, not on this slide, but also available is the bonus depreciation. So between bonus and 179, those are both accelerated depreciation methods where you can write off a bunch of stuff in a hurry, and you can generate a tremendous amount of expense in a short amount of time. Now, going back to that, pre 2012 timeframe, what we were finding, and I was working with the association during that period of time. The common practice is that that was during that high income period of time. People were just buying machinery or any equipment that they bought. The automatic default thing that they did was they just wrote everything off. Well, over a period of time, if you do that, you don't get, normally depreciation, new machinery right now depreciates over 5 years. So you get that cost spread over the 5-year period of time. If you write everything off in the year that you buy it, all of a sudden 5 years down the road, you've got no depreciation rolling into that current year. So the only way to generate depreciation, if you get into that habit, is to go out and buy something and write it off in that year. And that may not be the best management decision that we can necessarily make. And it's essentially the same consideration on the bonus side. I don't have the details on bonus in this slide deck, but just in general, that's one of the downsides of accelerated depreciation. Garen, go ahead and advance it, please. The other thing that we can do, in my entire career, I've only ever worked with 2 people that were accrual basis tax filers. I mean, the vast majority of people are cash basis. If you're a cash basis filer, you can prepay up to 50% of your Schedule F expenses at the end of the year. Now, that's a tremendous tax planning tool, but remember, you are limited to the 50%. All right. If you go over that, technically it's a deferral into the following year. You don't lose the expense, but it gets counted on the next year's return. And as the slide says, it's, it needs to be an actual purchase. You just can't go to the co-op and put money on account. You actually have to be buying something. Now, in years of high income, and I've seen this happen several times where, basically the producer was maxed out on the prepayments. Garen, go ahead and advance it in the next slide. Now this slide is possibly a little convoluted. It could have probably made a graphic out of this, but think of this in the present day, 2021. Okay, we're in 2021 tax year. All right, the two things that you can do from a cash basis side, outside of accelerated depreciation, is you can defer income from 2021 into 2022, which of course is going to add income to 2022. The other thing you can do is you can prepay fertilizer, seed, chemicals for the 2022 crop, but you can deduct it in 2021. Now, if you do both of those at the same time, you really magnify the problem, because what you're doing is you're pushing income into the next year and you're reducing effectively the amount of expense that you're going to be able to take in that following year. So if somebody does that every year and keeps magnifying that, that's what we call the deferred tax problem. Because all of a sudden, if you were to draw a line in the sand with all that deferred income into the following year and the inability to have expenses, it can result in a really, it starts setting you up for a really large tax bill, is what happens. So go ahead and advance it, Garen. My basic philosophy on this is I've always been a pay-as-you-go type of guy. I think the best way to manage the tax bill is, you're in the association, look at your last 5 years worth of FinAn reports. All right, look at that accrual adjusted net farm income. Now, just hypothetically, if you've got the last 5 years and you've been earning 100,000 plus for adjusted accrual adjusted net farm income, and you haven't paid any tax at all, folks, that's not sustainable. The taxes due, we're just kicking the can down the road. And what sometimes can happen is you can get pressed into that situation to where you may have several years of very little tax, but then all of a sudden the hammer comes down. This is a graph, some folks on here may remember when I was with the association, this was a graph that I used to share at tax planning time. And what the graph does is it looks at the blue line is the regular income tax rate, the orange line is the self-employment tax, and then the green line combines those two. You see the big hump that starts at about 81,000. Well, that's where you're going to the higher bracket. You're jumping from the 12% up to the you're going from 12% up to the 20%. And what you do is if you're in the middle of that green hump, that's where it makes sense to prepay down to where you're at the top of that 12% bracket. And we're still I have trouble saying the 12% bracket because of the 15% bracket for so many years. But I think what you need to do, though, is you need to look at, over time, what has been a good average net farm income number for your farm, and, pick a spot that's kind of a good benchmark for you to start at. When I was with the association, we had a lot of producers that just shot for the top of the 15% bracket. And, they would make adjustments to just get at the top of that 15% bracket. So they were paying as they were going, but they were trying to stay out of that really expensive money, try to stay out of the expensive brackets. And I think that's a good way to go, because it, as I said, I'm in that category where I promote, the pay-as-you-go method, rather than try to avoid tax altogether. And then all of a sudden you have the 1 year that where the hammer really comes down. Garen, are there any questions? Oh, excuse me. Other thing, this is just a real quick thing, and income averaging probably will be in play for the next year. It was probably in play for 2020 as well. All income averaging is because, you know, we're expecting, you know, with crop prices right now, incomes were up last year, and, you know, the way crop prices are looking right now, it could be another high income year. What you're able to do is, if you've got high income in that current year, you can basically put money back into unused brackets into the prior 3 years. And, you know, that's something that helps. But if you filled up that 12% bracket in the prior years, it's really not going to do you any good, because, you know, if you put back, you know, if there's no room to put any money into those prior year brackets, it's not going to work. You know, and right now we're, you know, that 12% bracket kind of replaces the old 15% bracket, and the 22% bracket replaces the old 28% bracket. Okay, any questions, Garen, that we have here?
No questions, but I do have an observation. You're 100% right on that deferred tax problem. I see many folks right at retirement saying, I've spent my whole career pushing income back, pulling expenses forward. What can I do? There are no easy answers at that point, are there, Rob?
Well, I think, you know, my general rule of thumb was it takes 5 years to get, you know, you ought to work on that 5 years before you retire. I have had people, you know, former association members that were retiring, and they said, hey, what would it cost me if I were to quit farming today? And, you know, you give them the number and you hope they don't grab their chest and fall on the floor. But, you know, it's because it's a horrendous number.
Right. Here's a good question. What would you suggest if this was your first year farming tax-wise?
Look at that. So they have no prior analysis.
Right.
Probably just need to look at where they're at income wise. I mean, they probably don't need to pay a ton of tax in the first year, but you know, I think they need to probably pay at least some, you know, because if you got the self-employment tax paid in there, there's disability insurance benefits to making sure that you're paid in on Social Security, and especially for a young person, I think that's important.
Yeah, good point. Good point, Rob. Well, thank you everyone for attending our webinar this morning. I can't leave without putting in a little plug for the association. If you want some help in determining your cost of production, looking at your income on a accrual basis, boy, that's exactly what we do here. We have a little saying here: if you don't measure it, how can you manage it? And boy, knowing your cost of production is so important in your marketing plans, figuring out your cost structure. So if that kind of thing interests you, don't be afraid to give me a call or an email. Here's our website. We try and keep that up to date. I'm also going to give a plug for our Ag Business Management Team blog. Boy, the people that write that do an excellent job on timely topics. That's my go-to place when something new comes about. So I would like to thank Megan, Dave, and Rob for joining us this morning. Please share your feedback with us in the evaluation that Emily just put in the chat. Our next Advancing Ag webinar will be on Wednesday, June 23rd. Bruce Potter will lead a discussion on pesticide resistance. How do you know what's happening to you? So with that, thank you much for joining today, and have a good afternoon, everybody.
Okay. Thank you.